Thank you, and good afternoon, everyone. And I am delighted to welcome you to Compeer's webinar on ESG and question if it is the next source of growth for the wealth management industry. First, I'd like to thank our sponsors, BITA and Crealogix, both of which we will hear from shortly, for their continued support in the running of our series of webinars. Also, thank you very much to each of you for logging on and making this webinar very much worthwhile. So as a part of admin, you'll see that there is a Q&A button at the bottom of your screens, so please feel free to use this at any time to pose a question. Although we will not have time to answer questions after each presentation, there is a panel session later, and so I'll look to pose any relevant questions to the panel, and if that's not possible, I'll arrange for these questions to be answered after the webinar. And so just to kick off this webinar, I'm going to take a few minutes to talk you through some key findings that we've surrounding ESG and its use in wealth management. And ESG was very much the hot topic before the COVID-19 pandemic took centre stage. And so I'm therefore going to share some of the findings from recent investor research pieces to prove that the level of demand in ESG was very high prior to this outbreak. And then our other speakers and panel will go on to discuss what lies ahead for the future. So my first two slides are going to be based on Compeer's own investor research, which was of 1,000 affluent and high net worth investors. And these results were taken from the survey conducted in late 2019. And one question that was posed was whether or not the fact a firm has an ESG offering has any impact on how that firm is viewed by potential new clients. And the answer is that it certainly does have an impact, and with that being a positive one. So we have close to half the investors that we spoke to suggested it would have a moderate or high impact on how they view the firm. And so it clearly is an area well worthy of firms investigating further if they're not already in this space. And I then wanted to take a deeper dive into the results to find the sweet spots where demand for ESG is likely to be the highest. And firstly, by age, it's very much the next generation of young investors, so those under the age of 40 who are seeking ESG services, with as many as 61% stating that it has at least a moderate impact on how they view a wealth management firm. And then by wealth, it's the richest clients with the highest proportion in the moderate or high impact categories, which should alert many firms, given that these are often the key target market for them. And then finally, by gender, we have the female investors came out on top. However, they only just edged out the males, with 49% being impacted as opposed to 44% of the males. However, I'm by no means stating that targeted ESG campaigns should be utilised for only the young and wealthiest clients. Actually, across all age and wealth bands, at least 40% suggested a moderate or high impact of ESG. And so it should be a consideration across the entire client base. If we could move on to the next slide, please. And now here's some other key findings that I wanted to bring out from that investor research. And firstly, we asked investors to select the key criteria that they use when selecting a wealth manager. And the value of 10% that placed the availability of ESG in their top three criteria may at first appear low. However, to put this into context, each investor was actually given 12 different options to pick from, which included the likes of investment performance, level of fees, brand reputation, and the actual relationship with the firm, to name a few. Therefore, it's actually credit to the demand for ESG that it made it into the top three for any of the investors, with 3% actually placing it as the key criterion they use. And then we have just over 1 in 4 investors stating that significant or very significant improvements are required in ESG, with 60% of those stating that they would consider leaving if improvements were not made throughout 2020. And so that means that on average, 15% of all clients could actually switch purely because of their dissatisfaction with the ESG offering. And then finally, we have 1 in 5 actually place ESG investments on the must-have list for a wealth management firm, with that value rising to 28% for those under the age of 40. But my stats do not stop there, so if we could please move on to the next slide. Now, our final two slides contain information from a survey we conducted on behalf of Brooks Macdonald for their research specifically into responsible investments being the choice investment for the new generation. So thank you therefore to Brooks Macdonald, from which Ben Palmer will be joining us in a panel session later, for allowing me to share these results with you. And this survey used a sample of 800 affluent and high net worth investors and very much supports the view that the demand for ESG was very high prior to lockdown. And this first slide looks at the awareness of ESG offerings from their main wealth management providers. And this is actually an area of concern that I have for the sector, as with over half of the investors being unaware of any such offering. And as age reduces, the awareness level increases, as it is a key focus for the younger generation of clients. But now I would hope that far more than 15% of firms are offering ESG. And the reason I use this figure is it is the proportion of investors over the age of 65, which for many firms is actually their key source of clients, that are aware of ESG services from their main provider. It may, however, be the case that firms are currently targeting younger clients with any campaigns. But this is unlikely to be the best approach, as across all age bands, more than 2/3 of the investors who are aware of the service are actually using it. Therefore, as mentioned before, it is very beneficial to market ESG services to all clients, as the uptake is likely to be high. If we could move on to the next slide, please. So I then wanted to calculate a total demand figure for ESG. And for me, total demand is made up of those currently using the service, plus those who are unaware of any ESG offering but would like to see one from their main provider. And then finally, plus those who are aware of the services but suggested they would consider using them before the end of 2021, even if they are not currently doing so. And this provides some staggering numbers. So across all 800 investors, the total demand was 80%. But what's even more noteworthy was that among those under the age of 40, the demand was as high as 94%, which to me makes a no-brainer that wealth management firms offer some form of ESG or responsible investing service. And also, although not shown on this slide, when asked for the proportion that they are already invested in ESG, the average was 48% of their entire portfolio, with the likelihood originally being that this is going to increase in the future. Therefore, the potential is huge and could be as high as 400 billion in ESG in the near future based on these proportions. And then my final chart on the right-hand side of this slide, I included in order to show that linking ESG to a sacrifice in performance is somewhat of an urban myth. In fact, over half the investors felt that ESG actually supports performance and will have a positive impact on it, with just 15% believing it has a negative impact. So that completes my intro to the demand for ESG. And so I'm now delighted to introduce our first presentation from Crealogix, with both David Joyce and Kim Woodhall speaking on empowering digital wealth clients with impact criteria. So over to you, David, to kick off this presentation.
Thank you, James. Good afternoon, everyone. Let me start off by introducing myself. I'm David Joyce. I'm the CEO for Crealogix here in the UK, and I'm joined today by Kim Woodhall, who's our Global Wealth Product Lead. We're going to be followed by speakers and a panel expert on the topic of sustainable or impact investing. So our presentation today is going to focus on the role of software, specifically the software with which you communicate with your customers, the system of engagement, an area in which we specialize at Crealogix, and how good user experience, UX design, can go some way to demystifying this topic for the end client, empowering them to make their preferences clear. Next slide, please. So whilst acknowledging the impact of other macro trends and drivers such as economic, especially the health crisis that we are still living through, and the impact that will have and is having on global and local economies, and also regulation increasingly opening up and creating greater access to retail investment markets, it seems clear that ESG or impact investing are and have been for some time a mega trend or driver, if you will, within wealth management. And I think it's inarguable that increasingly they are becoming just a normal dimension of investing. The groundwork for this, I suppose, has been being laid for a long time now. And some would argue that it's only now perhaps in the last couple of years, but it's really coming to the fore. For instance, taking centre stage, the Davos Manifesto in 2019. Next slide, please. But as they say, actions speak louder than words. And there's clear evidence building that investors are voting with their feet and that the wealth management industry is having to respond. Next slide, please. And whether it's launches of new funds, as on the previous slide, or the inflow of funds, it's becoming clearer that this is indeed becoming the new normal. Next slide, please. Impact is increasingly becoming the lingua franca between advisors and their clients when it comes to suitability. And clients are taking much more proactive interest in their portfolios and their sustainability credentials. Next slide, please. I'm going to build on perhaps some of what James was talking about in his slide in terms of the generational gaps on this topic. And there's no less evidence of how the different generations of investors are coming through and viewing this topic. And Gen X are typically generalized as being materialistically driven, and Gen Y or millennials as globalists. Whereas Gen Z or Z investors, some of whom are already 25, are driven ethically. And it's these millennials and Gen Z generations that represent the emergence of the digital native. Next slide, please. In fact, it could be argued that there is a perfect storm brewing, at the centre of which is the activation of new investors, those that perhaps expect to be able to do everything digitally, that presents both the greatest challenge and opportunity for firms. And you saw that from James's data earlier. But it's how to engage with them in a meaningful way with respect to impact investment. It's as much about content as it is about design. And that's where I'd like to hand over to my colleague, Kim Woodall, to take the story forward. Kim.
Thank you, David. Next slide. Actually, David, I think this one was your last slide.
Yeah, that's it.
Okay. Good afternoon, everybody. At Crealogix, we believe that digital solutions enable businesses to make the most of these opportunities. Digital offerings provide benefits to both clients and to wealth management firms. Some of the benefits to clients are that it increases agency by empowering clients to be actively involved in their investments and easily communicate with their advisors. It also increases transparency because there's more information, news, and research about what they are invested in readily available. And it's convenient for clients as they have access to their accounts 24 hours a day, 7 days a week. Next, please. And benefits to the firm are that it improves client engagement. For example, there is a sentiment amongst next-gen investors that there's no point in investing because the world might not be here when they retire. However, as they are digital natives, a digital offering provides a way to engage with them, and it also makes them feel that they have a way to contribute towards a more sustainable future through investing in ESG funds. By attracting next-gen investors, it helps attract new clients, but also keep existing market share during the intergenerational transfer of wealth. Digital offerings also provide ways for businesses to be more efficient. For example, digital onboarding is more streamlined and quicker for clients, and it's greener as there's no paperwork involved. Next slide. There are both pull and push factors for ESG investing. The pull factor is that there is an increased demand from clients to invest in ESG funds. And the push factor is that there are regulatory changes underway to take sustainability risk into account in the advice process. For example, since 2018, there have been over 170 ESG-related regulatory measures proposed globally. That is more than the previous 6 years combined. And for example, in the UK, the Department for Works and Pensions is currently undergoing a consultation where they are looking at how trustees of occupational pension schemes can introduce measures to effectively assess and measure and manage climate risks and opportunities. Another regulatory change underway is that the European Commission, in conjunction with ESMA, last year proposed changes to MiFID II to bring financial advice firms into line with the EU's climate action plan through the integration of sustainability and ESG considerations. The final rules and guidance of these amendments to MiFID II are expected to be published later this year and come into effect during the first half of next year. The FCA has indicated that it plans to mirror the European initiatives in this area. As the quote here says, in November 2019, the EU parliamentary regulation stated advisors should take sustainability risks into account during the investment selection process, regardless of the sustainability preferences of the investors. However, we believe that client preferences should be seen as equally as important as regulatory compliance, as there is both the pull factor of clients wanting to invest in ESG funds and a desire for agency and transparency. It is therefore worthwhile to take some steps now and consider how to embed ESG preferences within client fact finds and the annual review process. This will help put you on the front foot of these upcoming regulatory changes and also gives you an opportunity to attract new investors who are interested in ESG investing. Next slide. A way to do this is through incorporating ESG preferences through an online portal. Clients can be empowered to express their choices, for example, selecting what they're interested in, which would then feed into their news and research feed. Next. Another idea is that clients could also choose which areas they are concerned about and select what they do not want to invest in. Next slide. Firms and advisors are increasingly empowered with a wealth of ESG data. However, this also comes with challenges due to the lack of standardization of this data. Nevertheless, there are initiatives underway, for example, by the European Commission, and also a collaboration between two of the leading ESG standard organizations in the US and Europe, which are promising steps on the road to ESG data standardization. In the meantime, as Fiona Reynolds said in the Principles for Responsible Investment, obviously having the data is important, but you can't let perfect be the enemy of good. Sometimes you just have to get on with things. While the data challenges are being addressed, another area to focus on is that from a client's perspective, they want to be able to assess and view ESG data in a clear and meaningful way. Next slide, please. A way to do this is, for example, you could look at using the ESG, the UN's Sustainable Development Goals as the selection criteria for investors. Next, please. And using those, you could add them to the online portal and in a very simple and visually appealing way, enable clients to select their impact goals based on the UN's Sustainable Development Goals. Next slide, please. Another option is actually to have well-designed groupings of themes that can help simplify the user experience. For example, here the client could select their investment goals based on groupings of areas of interest, such as basic needs or climate change. Next, please. By using impact themes as a way for clients to select their ESG preferences, this is a very simple but intuitive way for them to express what they want. Next slide, please. Once you know your client's preferences, a firm can then personalize recommendations and recommend certain impact funds or ESG funds which are in line with what the client is looking for. Next slide. Existing clients could also use this new ESG criteria as a way to assess their current investments, and in a visually engaging way, such as this, be able to assess which of their investments currently meet their preferences and which are the areas in orange or red that they might want to drill down into and assess and might want to reallocate. Next slide, please. Crealogix is a partner to wealth management firms in creating engaging digital solutions. Please feel free to contact us if you would like to discuss any of these ESG preference digital ideas that we have discussed today. Thank you, and I'll hand you back to James.
Thank you, Kim and David. I'm now pleased to introduce our next presentation, which is going to be from Daryl Roxburgh of BITA Risk, discussing a practical approach to ESG management. So over to you, Daryl.
Thanks, James. Just making sure I'm unmuted before I start. Good afternoon, everybody, and thanks for joining us on this webinar this afternoon. I'm Daryl Roxburgh from BITA Risk, part of the Core Financial Group. And to just put us into context, a quick anecdote. During the Extinction Rebellion, I was stopped by a very nice lady and asked, "You work in the city?" I said, "Yes, I do." She said, "What are you doing about climate change?" I said, "Well, I run a software company, and my clients are probably responsible for somewhere between 160 and 180 billion pounds in the London market, and we're trying to take ESG data to those client portfolios." She said, "Okay, so obviously your heart's in the right place, even though you work in the city." So in the next 15 to 20 minutes, I'm going to look at the practical aspects of ESG management. The theme of this conference is looking at how ESG can potentially help with the pressures on asset valuations and maintaining growth, both in portfolios and business volumes, in a period of potentially extreme volatility. So the task is to deliver growth, reduce risk, and do this efficiently. So how can ESG help? While looking at this, I'm also going to consider 3 questions raised by our clients as we have been implementing our BITA ESG Manager. Why do we need it now? What data should I be using? And how to prevent over-constraining a portfolio. As I go through this presentation, it will become clear that data is driven by need and use, and that ESG is very much more than just ESG. So why ESG? Next slide, please. The first thing to remember is that ESG is much wider than just the environment. While the environment is critical, ESG is also about measuring corporate behavior across social and governance areas as well, and often is used to encompass wider still definitions and data. Fundamentally, investing in stocks with high ESG scores is backing good corporate behavior in environmental, social, and governance policies. But never be misled by a single overall score. It may not mean that the company or a fund is good in all aspects. So ESG investing matters from the perspective of climate change, social well-being, and well-run companies, which are important, as James has already shown, to a growing set of clients. But this is not the only reason by any means, as to why ESG scoring and using that scoring in investing is important. Next slide, please. From the investment standpoint, it has been shown over many years, and not just in 2020, that firms with long-term sustainable corporate strategies have performed better than those with weak strategies. This has been borne out in the 2020 crash, where highly rated firms have also been more defensive. But let's look at this in a different way. ESG data provides insight into where companies invest in R&D and trends in forward-looking products and markets, helping to identify potential future growth. This, through positive screening or search, helps you identify firms involved in renewables, cyclical economy, clean tech, and other growth and future areas. If we look at the UN Sustainable Goals, a number of these are directly related to innovation. And if we look at for example, at the MSCI Sustainable Impact Metrics, such as product R&D in green building, alternative energy, sustainable water, energy efficiency, pollution prevention and sanitation, these all give clues to a forward-looking corporate investment policy. So ESG data in its broadest sense can help find and select companies in future growth areas. And you should also consider identifying companies active in emerging markets, emerging in terms of demand as well. So that is looking at the positives from an investment perspective that can be derived from ESG data. Let's next consider its use in risk avoidance. Next slide, please. This goes way beyond traditional sector risks. A phrase often used is the social license to operate. This is the concept that a company ultimately needs the support of the public, its shareholders and stakeholders to operate. And stakeholders also include its workforce. This is becoming more and more important, especially as the public can actually now be a very small, high-pressure group and have dramatic impact. Understanding the controversies, another part of ESG data, around a company. The news, for example, last week, that Rio Tinto's CEO was forced to resign over what would be categorized as a social factor or controversy. Understanding how these controversies and negative scoring could impact a company's future and acceptance of its products is key to understanding the risks to that company going forward. You should think of David and Goliath, except David now has a Facebook page and millions of followers. And social media has changed the perception that an individual can now really make a difference. Individuals can together drive companies' behavior or not condone bad behavior or force change. So understanding where the risks lie in a portfolio is important. And again, ESG data can hold the key. So ESG is good for the investment manager as well as for the client. Next slide, please. And lastly, ESG is a powerful message in marketing. ESG meets the zeitgeist of climate change and caring about the world that we live in. This can now form part of a client's utility, wanting to invest for good as much as for profit. And it is shown that it aids investment and risk management at the same time. ESG can increase client involvement with their portfolio and interaction with your firm, strengthening the relationship. It can bring a new level of communication with the client, and it extends beyond portfolios to your firm's image and brand, a point borne out by James's analysis. This impacts both sales and recruitment of staff into your organization. So overall, it is a powerful marketing message that can drive sales with propositions that do not have to sacrifice performance. Next slide, please. And then there's regulation, and that's coming in thick and fast, as we heard a moment ago, and so I'm not going to cover that. But to summarize why, in terms of this being positive from a client perspective, positive from an investment perspective, and positive from a marketing perspective, we then need to look at how do we actually put this into play. So we're going to review product and policy, data and process. Next slide, please. In looking at a firm's ESG policy or their responsible investment policy, or that probably not sustainable because that now has regulatory connotations, we think of the 4 Ps: proposition, policy, preference, and portfolio. Turning to the proposition, how do you apply ESG in your investment solutions? You have to decide. Is it embedded in research and therefore inherent in a product? Is it through specific ESG-focused funds, potentially being thematically based, or in ESG-enhanced portfolios? Or is it just a general part of your client portfolio management, with the client having an ability to express preferences? And then in each context, how do you actually define ESG? What is it? There are many hundreds, if not thousands, of characteristics that can define, that form part of ESG. Which ones are you thinking about? Will your firm pre-screen or buy lists by certain criteria? And can you then articulate those criteria, giving a baseline to any client preference discussions? And then what are you actually going to report to the client? And what caveats do you put around trade-offs between strengths in one ESG factor versus weaknesses in others? Moving on to policies. How will you handle collectives? Will you use look-through or an aggregate score? Can a client's preferences be applied at a detailed level if you're only using collectives? How do you avoid empty portfolios when offering a client choice in preferences that could over-constrain? How do you handle non-reported or missing data? You need to be aware that not every firm has every data item when you look at a data vendor's matrix. And it's not meant to in many cases as well. What is your source of ESG data? Do you understand the methodologies and strengths and weaknesses behind this, and how data is aggregated up? This is a core part of your investment process and needs to be able to be understood and articulated, especially as people talk often about the fact that different vendors give different answers. It's because the aggregate scores have different components. How will ESG be monitored? Can you look at trends in ESG across the client portfolio? What actions will be taken when conflicts are found? And so we then look at preferences. What level of granularity in terms of preference is offered to the client? Does this vary by client segment? How do you cope with off-piste requests? And then lastly, portfolio management. How are portfolios managed in line with preferences? How are conflicts managed? And how is this communicated to the client? So you can see there are a lot of considerations for a firm in terms of structuring ESG management within its portfolio sets. But having set proposition and policy, we know what preferences we might offer the client and what information we may want to use for managing the portfolio. And this leads us to data. Next slide, please. In this simplistic schematic, and the reason I say that, in reviewing one of the major data vendors' data dictionaries recently, we found that they had over 2,000 data items potentially for any given firm. We start with the firm on the left and then look at the range of data that can typically be provided under the broad ESG banner. If we look at categories, we have E and S and G, and then impact, controversies, and climate, and then product involvement. Beneath each of these, for illustration, I have put 4 theme groupings. So, for example, under environment, we may then have pollution and waste as a theme, and then underneath it, a series of factors or key issues. Products may be grouped in terms of product exposure or revenue exposure to things such as alcohol and tobacco and gambling. Products may be grouped by religious screens or armaments or healthcare, with detailed product exposures underneath. Controversies may be grouped under themes such as labour, environment, or product. So you can see why I said this is a simple schematic. And here I ended up with 140 factors. While this level of granularity may be very useful to an investment manager or a CIO team or a fund manager, in most cases it's far too complex for the client. It's a case of understanding what you're looking to drive. The investment approach and the client preferences will quite often come from opposite directions in terms of the need for granularity. The client may have a general requirement or specification, and you as an investment manager may be looking for a more granular information in terms of identifying investment risks and opportunity. What is key is that the investment manager has more granular data available to them than the client can express preference levels. It is also key that the investment manager can identify where there are poor scores within a portfolio, especially if a client has expressed a preference further up the tree. So an asset may look good at an environmental category level, but the manager needs to be aware if that firm has environmental themes or factors where it scores badly. So overall data management and data understanding are absolutely key. Defining what is meant by your firm in terms of ESG is key. And then if we dig deeper, we have considerations as to whether to use absolute data for a firm, best in sector data for a firm, or trend data. So now we have a clear view of the data and how it can be used. We will look at client preferences. Next slide, please. As an extension to our client profiling, we have done a lot of work on understanding client preference collection. And we came to a conclusion very early on about three things. Don't lead the client, don't overwhelm them with choices. Let them ask for what is important to them. And there are a number of different ways of achieving this. Secondly, set a low watermark. That is the baseline at which you would consider investing in companies in terms of the scores, i.e., let the client defer to your judgment in the absence of strong views or convictions. And thirdly, illustrate the impact of a preference on restricting the investable universe. These address a worry expressed to me that clients would overconstrain the portfolio given infinite choice of preferences. To do this or prevent this, we need to look at what is the appropriate level at which a client wants or needs to express a preference. This will not necessarily be consistent across clients. It may be that in terms of initial capture, you do not want to provide the client with a long list of options that they can just tick, but explore the general areas in which they have a particular interest and then focus in on those. To do this, your ESG preference question set needs to be comprehensive and flexible. Our initial questionnaire can be answered with just one question, and I don't mean no, I don't care, or dive down into a selection from over 150 different factors. Considering collectives, if a client has very specific preferences, then it may not be possible, even with the aid of look-through, to find funds that will meet these requirements. It should then be questioned whether the client should be in a direct portfolio or remove some of the restrictions. Next slide, please. In practice, ESG data is complex, and it needs to be considered at the level that a client's preferences are set, as well as meeting the investment manager's needs and giving them the insight to comment on a company through diving down into the detail of individual assets and their factors. I just mentioned that the BITA ESG preference questionnaire. This forms part of the BITA ESG manager that provides a solution from preference capture through portfolio ESG screening, portfolio what-if and conflict assessment, to detailed analytics, risk management, and client reporting, based on your firm's choice of data vendor. We have taken the view that ESG is integral to portfolio management and monitoring. And so an investment manager can check the impact of ESG-driven ideas on the portfolio risk, return, macro factor metrics, while also ensuring that the portfolio remains suitable and on mandate. We've worked at BITA Risk to deliver this complex data to the user through visualizations that allow rapid assimilation of information and identify key calls to action. This has already been described by a leading head of private clients as a game changer in client communications. Considering a portfolio against its benchmark in terms of factor exposures, considering a portfolio against client preferences, and identifying complex conflicts, and looking at both investment risk and investment opportunity factors are all key to the investment process. Next slide, please. So to conclude, ESG matters to the client, ESG matters to investment process, but ESG and the factors that you use have to be defined. Data is complex and has to be understood. Policy and control are key, and ESG should be an integral part of your investment process. But as I discussed with James before this started today, our view is that ESG in many ways is another form of Darwinian evolution of product in the investment management industry. If you think when hedge funds were launched, you bought a hedge fund. They quickly changed and morphed into different themes and approaches. ESG is still in its infancy despite the rapid and massive uptake of it. And we will see over the next 18 months, 2 years, a rapid transformation in the way that it's delivered to clients, defined to clients, and regulated as well. So thank you very much, and back to you, James.
Thank you very much, Daryl. We'll now move on to our keynote speaker. So Robert Rubenstein of TBLI Group is a leading expert in impact investing, and he's going to be looking over 25 years of ESG investing and what lies ahead. Well, welcome, Robert, and over to you.
Good afternoon. Thank you for the invitation. 25 years and 10 minutes. Okay, let's start. Next slide. For those of you who don't know who TBLI is, my wife likes to say we make dreams come true, but we're not in cosmetics. Our work is to make the financial system work for all by educating asset owners and managers about sustainable investments. Next slide. These are the things we'll cover. What has happened in the last 25 years? What are the forces driving it? What are the opportunities? Where are we and where do we want to be? In some definitions and addressing some of the myths. Okay, next slide. When you're trying to convince people about ESG and impact investing, which we've been doing for the last 25 years, how they see the earth, do they only see it as a risk or an opportunity, is quite important on how they respond. Next slide. Risk, opportunity. Next. Here are some definitions of what is ESG, or extra financial investment. The top three: people, planet, profit, social and environmental and economic issues, and that it adds social and environmental value. The definition that TBLI uses, the last one, is basically while you're making money, are you worsening, maintaining, or improving the social environmental balance? Most companies are worsening. A very, very, very small group are maintaining, and nearly none are improving. Next slide. Here are the differences between ESG and impact. ESG is quite liquid. Impact is less liquid. ESG tries to provide value add in long term. Impact tries to achieve that in the short term as well as the long term. ESG is often about avoidance. Impact tries to be restorative. ESG is somewhat measurable. Impact tries to be clearly measurable. And most important, which is why so many are interested, is ESG is correlated and impact is not correlated. Next. This is the main reason why there's so much interest in impact investing or sustainable investing. Basically, China's growth of 8% a year, they reach U.S. consumption levels by 2031, if the 8% is accurate. And what that means for all of the commodities, anticipation is they might need 50 to 80 million barrels of oil a day. They might consume 2/3 of the world's harvest, most of the meat, coal, steel, paper, cars. So many commodities. Then you add India and the other 3 billion emerging markets. You do not have to be a Nobel Prize winner to realize that this linear line going up of continuous growth is not possible because there's just not enough resources at this level of growth with inefficient use of resources. So what is the investment opportunity? Conflict, investors like war for a little while, not too long. But the real opportunity is massive resource efficiency, and basing on a restorative level, that is really what's really driving a lot of interest. People have done the math. Next slide. So if we look at where we're coming from, next. Surprise, surprise, people with bad credit and no money couldn't afford to buy a house, which led to the housing bubble. Next. The challenges that we've always faced is basically ignorance. There is a perception that needs to be addressed. It's mainly dealt through education. Next. How do we get buy-in? That's really the key. It's not that hard. Actually, it's quite surprisingly easy because the financial sector is a very predictable group. Next. Basically, the challenge is not the convincing, the challenge is access. People with a lot of money, the more zeros they have, the more isolated they are. The access is really the challenge. Next. But I found that pain is a very effective way in getting people's attention. Particularly the business community. If they continue in a direction that's very painful, you will get behavioral change and you will get their attention. Next. You have to also focus on the self-interest, as Milton Friedman said. Next. And the money flows. Next. So if you focus on these three things, self-interest, opportunity, and money flows, and do it over and over and over again, you will get behavioral change. But it is a farming exercise where the financial sector are hunters. Next. These are the myths. Most people think impact is charity, no returns, no deals, money losing, no scale, too risky, bad management, no track record. All myths. The same as the next myth. Next slide. All investment managers always hit their benchmark. I haven't met that group. Private equity funds always earn 30%. Who? They haven't done it in a long time. Hedge funds always earn 30%. These myths have been sold for a long time and generated quite a lot of money. So I think we need to look at all of the myths, not just the myths as perceived about people who just don't understand what is impact investing. Next. I always heard that ESG data over and over again is not good enough. If you look at the financial data, it's much worse. Next slide. If you look at all of the scandals we've had, the China hustle, which is the big short in real time, WorldCom, Enron, Parmalat, Madoff, the financial crisis, trillions wiped off. I haven't heard anybody say, the financial data is not really good enough, and this is very bad. People seem to have accepted that, but there's never been a single major screw up on bad ESG data that led to the downfall of a company. In fact, it was the analysts, this ESG analysts, that had warned about BP because they were spending 8% less on health and safety. But the investors said, that's the financial answer. That's good. They're making more money. Next. Sustainable investing is risky. So I hear that a lot. You know what the $350 billion represents? That's the amount of money the financial sector, it's actually close to $400 billion now, that the financial sector has paid in legal fees and fines since the last financial crisis, not this one. Next. Drivers, again, to kind of summarize, the emerging market resources, resource inefficiency, wealth holders looking to integrate philanthropy and investment, financial crisis and the aftermath for the sector, all the fines, staff and clients looking for purpose, some regulation, which is increasing with the EU taxonomy, stakeholder pressure, student and employee demand on employees and endowments, wealth management, engagement with clients around impact, which is a very big missed opportunity. They just don't get it. You can engage with their clients on this subject much better than saying, I'm sorry, your portfolio is down 3% because interest rates are low. Self-interest and, of course, the business case. Next. These are the most important things. I'm not going to go into all of them because of time. The most recent one is a carbon tracker report. But if you want to look at the others, Carbon Tracker, Freshfields, PRI, Crater Principles, the Disclosure Project, and the Montreal Pledge. Carbon Tracker, next slide, is a very important development. They said, okay, if we have to stay at 2 degrees, how much carbon can we burn? Okay, so we can burn 800 some odd gigatons. How much have we burned? 200 some odd gigatons. How much we left? 560. Okay, so to stay at 2 degrees, we can burn 560 gigatons. Okay, how much is in the ground? 2,800 gigatons. Oh, 2,200 gigatons more than we can burn, but they're on the balance sheet of companies claiming that it's worth so much a barrel or so much ton. So maybe those financial information about the reserves are not that accurate. I'm not saying that we will stay at 2 degrees. I don't think we will. But if you need to do that, you cannot burn the amount of gigatons that you have on the ground that are on the balance sheet. That woke up a lot of institutional investors, particularly those in fossil fuels. Next. This is the breakdown of that. If anybody wants a presentation, just ask Compeer and they'll send it to you. Next. So money flows. If we look at some of the money flows. Next. Complete wipeout of the coal companies without much fanfare, even though they had a big hero in the White House with Trump who said he was going to bring back coal. It's not coming back. It's going away. Next. Massive wipeout of the oil sector where oil was being sold, that they would pay you to take away the oil. Next. This is a breakdown of ESG and the asset allocation. Next, it gives a better slide. Next one. So the breakdown of $30 trillion in 2018 going into ESG, mainly liquid assets. It's not looking at everything, and I'll get to these figures in a minute. Next slide. Some more breakdown of the relative to managed assets. Next slide. Breakdown of green bond market in 2018 shooting up dramatically. It's really going up very, very rapidly, but it will be impacted by the EU taxonomy as to determine what is a green bond. Next. This is the breakdown. It's probably about $1,100 billion that has gone into corporate R&D, life systems, energy efficiency, green construction, and renewable energy in the last 10 or 12 years. Next slide. These are the 6 focuses of most impact and sustainable investors, looking at food, water, energy, healthcare, education, and transportation. Next. Results. Let's see what have we achieved. Next slide. If we look at all of the problems we have, climate change, destruction, biodiversity loss, water shortages, food shortage, health crisis, particularly diabetes, income inequality, pollution, threat of war, how can you have 30 trillion? It's probably close to 40 trillion if you look at real estate and private equity and that. Either the 40 trillion is not going in that direction, or it's Coke Light, Diet Coke. It's not really a serious way of approaching, or we have to double down. Or the fundamental way of doing ESG is completely flawed because it's becoming a death march in the wrong direction. It's basically let's do less bad rather than the focus what it should be, let's do more good and let's be restorative. You cannot have all of these problems if all of that money is going in that direction. It just doesn't add up. Next slide. So I personally think we need a dramatic, radical change, a moonshot, a way of basically realigning investment that it should be restorative, that it fundamentally improves the environmental balance, it fundamentally improves the social balance, as well as making whatever the market rate return will be. Next. And we also have this issue, if you look at the press release, you think everybody, BlackRock, they're pouring trillions in there when the 4 major US banks are still account for 40% of fossil fuel investments. So the ones that are doing the most are talking the least. And the ones doing the least are talking the most. Unfortunately, people are following the press releases of those talking the most. Always open the kimono and see where the money flows go. Next. Why is there so much activity? Next slide. is basically the Paris Climate Agreement. Carbon as a cost now. Next slide. If we see the amount of wealth there is, it's 3.5 times the global GDP. Next slide. We have a 41 trillion wealth transfer to the next gen coming up, just the US alone. Next slide. And one of the greatest drivers for the financial sector, demand for talent. A lot of top people in the wealth management who worked there a long time are tired of the press releases of the private banks that are really doing nothing but talking a lot about it. So I keep seeing senior people leaving, and it's going to be harder getting the best and the brightest unless you have a fundamental, really long-term strategy of integrating sustainable investment in the way you manage money. Next slide. This is, I think, the greatest opportunity in the history of mankind. Zero-emission real estate, public transport infrastructure, fuel-free energy, carbon sequestering, investing in the 2 largest employers in the world, which is basically small-scale agriculture and hospitality. If you're looking for jobs, that's where the jobs are. Climate resilient cities, living wage. These offer great investment opportunities. There is no shortage of investment deals. Next slide. Next. Here are some simple, non-sexy ideas. Public transport infrastructure is a $2.3 trillion industry every year. Steady cash flow, no volatility, no really great technology risks. They're AA rated, often public-private partnerships. Very few people talk about decarbonizing their portfolio by using public transport infrastructure. I don't know why. Community banks, $2.5 trillion business in the US, another safe industry. The secondary market of development finance institutions, fuel-free energy, social stock exchange, and second-generation engagement, which I'll address another time. Next. Public transport ticks all of the boxes, really all of them. Next slide. Financial herd is forming. Next. People are saying they can create a portfolio, integrate sustainability in their whole portfolio. Next slide. This is not a suggestion of how you should do it, but you can if you want to. If you don't want to, it's very hard to do. Next. ESG is not a niche market. It's a big party. We just got here early. You know, you go to a party sometimes and nobody's there. You say, this is going to be boring. And then all of a sudden, people show up. You have the first mover because you're next to the food and drink. It is a very big party and getting much bigger. Next. Real estate. Next. So the largest green real estate retrofit was done by a man who didn't even care about sustainability, Anthony Malkin. He did a $550 million green retrofit and then ultimately sold the building for a lot of money and made quite a lot of money on that. Next. The largest SDG real estate project is in Bangkok. Next slide. Energy, fuel-free. Next slide. Fuel-free energy, renewable water, hydro, geothermal, wave, just growing very fast because the price has come down so much. Next. And why would you pay for fuel? I don't like calling it renewable energy. It's fuel-free energy. Next steps. So our next steps, next. Here is an overview of what you can do, some opportunities that are there, whether in liquid or illiquid space. We focus a lot more on the illiquid space. Next slide. We need less ribbon cutting. Next. And we need more people digging holes. Too many people cutting ribbon, not enough people doing the work. Next. And we have to move away from the financial sector. They are hunters. We need more farmers. We need a long-term approach. But the financial sector is incentivized for short-term behavior. They will not do a long-term behavior unless you incentivize for them for that. Next. So what can you do? Next slide. To paraphrase Yoda, do or do not. There's no try. Either do it or don't, but stop talking about it. Next. And we need less of these fluffy photos, which have nothing to, I see these photos used all the time on ESG or impact photos as if this has anything to do with the investments that are going there. Stop this. Next. Time's up. Thank you for your time.
Thank you very much, Robert. So this now brings us to our final wealth management panel session. And I am delighted to welcome back Daryl from BITA Risk, as well as Ben Palmer from Brooks Macdonald and Ian Aylward from Barclays. to share their experiences of ESG and responsible investing. And may I take this opportunity to remind you that there is the Q&A link at the bottom of your screens to pose any questions. And thank you to those that have already done so. And I'll look to get as many of these answered as possible. But let's start with some introductions for our new speakers on the panel. So starting with you, Ben, please could you give a brief introduction to yourself and your role with Brooks Macdonald?
Yeah, absolutely. Good afternoon, everybody. In the interest of time, I'll keep this very brief. My name is Ben Palmer, and I'm Head of Responsible Investment at Brooks Macdonald.
Thank you, Ben. And Ian, how about you?
Hi, I'll follow Ben's lead. I'm Ian Aylward, Head of Manager Selection at Barclays, but I also chair our Responsible Investing Committee.
Thank you. Well, I'll get cracking with the questions. So the first one, so since lockdown, have you seen any change in the investment preferences of your clients? So if we could start with Ben again, please.
Yeah, I think it's obviously been a very interesting period for the world in general, but certainly in terms of the responsible investment landscape as well. I think the conversations that we've been having through lockdown with clients have centered on similar topics when looking at sustainability issues. I think a number of the areas that have been touched on already, particularly around the climate questions or climate crisis, probably more accurately described as, are still very front and center of client considerations. But I think something that the COVID pandemic has really highlighted is maybe the S in the ESG acronym, and the social issues and social impacts of businesses. And not just in terms of maybe products and services and their impacts on communities and broader society, but actually just business behaviors with particular reference, obviously, with regards to how you treat your employees through this pandemic. And also supply chain management as well has obviously been front and center. So I think the S, which has tended to take a bit of a back seat in client discussions historically, has been thrown into the spotlight of late. Thank you, Ben.
Is it the similar case for you, Ian?
It is actually. Ben took the words right out of my mouth. I think I would have said, the key development from our clients is that the greater focus on that S. And the additional point I'd make is actually the greater time they had on their hands. In the very early days of lockdown or weeks of lockdown, perhaps they were more engaged with their investments. They had more time to look at their investments and then pay more attention to ESG considerations at that stage.
And thank you. Darryl, I'll slightly reword it for you. I mean, have you seen a change in the demands from your wealth management firm clients since lockdown?
I think given that I work in the software world, things move slowly. So a change in direction doesn't happen very quickly. But what we have seen is increasing interest now in how do we communicate this to the client? How do we manage this as part of our overall investment process? And I think with the sort of variations in MiFID and regulations around this space and sustainable investment, that's been a driver. But I think COVID, as Ben and Ian have said, has driven clients to think more about this, and firms respond to clients.
Okay, and on to the next question, and it's asking, do you believe that ESG investments are available from a sufficient number of wealth management firms? And the reason I ask is obviously some of the awareness figures shown from the investor research were lower than some may have expected. So I'll start with Darryl this time.
I don't think it's really for me to comment on individual firms. I think in the space that we work, which is very much the portfolio management space for sort of high and ultra high, firms are integrating ESG into their process. And that as I went through talking about the policy, it's there are a lot of decisions a firm has to make as they do that. And what I'm seeing is more and more firms are doing this. They're taking it from the team that worked in the corner for the last 10 years working on ESG to that team coming out into the limelight and actually being central to the investment proposition.
Okay, Ian, how do you feel about the number of firms offering ESG?
Yeah, I don't think it's necessarily my place to comment on others and on our peers' provision of products. But certainly at Barclays, I believe we have sufficient investments. If I had to mention just 3 strands, I would say that all our investments, all our products benefit from ESG that is embedded and scored in all of our external manager fund research. It goes right across the book. We also have a negative screen across all our portfolios. That's for controversial weapons, and that includes cluster munitions. Again, that goes right across our book. And then for those clients who are particularly interested in this space, that we have a specific sustainability product, and that's our impact fund of fund.
Thank you. And Ben, do you have anything to add?
Yeah, I would sort of echo a couple of points in terms of, I think it's very much up for each firm to come up with their approach. And I think this is one of the consistent messages from today, is that there isn't any singular way of approaching this. I think the important thing from a firm level perspective is to clarify your approach and be clear in your communications about what you are offering within your product suite, and also the other side of the same coin, what you're not offering. I think just at a kind of industry level, wealth management has got some ground to catch up. The potential demand, I think this is a very big opportunity for our industry. And certainly I think the institutional market is further down the line with regards to ESG integration and more specific strategies than maybe the private client space. But absolutely, I think we'll probably see further product development and business involvement across the space over the next few years.
Okay, now one of the stats that came out from the research was linking to ESG and hopefully not being a sacrifice to performance. Now, do you believe this is the case, that it actually can have a positive impact? And if not, how do wealth managers actually spread the word that about the performance linked to ESG and how it can be strong? And I'll start with Ian for that one, please.
Sure. There really are 2 schools of thought here, aren't there? There's the academic one that argues that by reducing one's investment universe, it must lead to lower returns. The other school of thought is that exclusions are often of those firms that will have poor returns in future, because they're not managing their ESG risks appropriately. And so returns will be better in the future from taking into account ESG. Now, clearly the latter is intuitive and appealing, but from a statistical perspective, it simply is too early to tell. For example, clearly ESG approaches have done well this year, but that could simply be due to being overweight sort of growth names and underweight the likes of banks and energy names. So I think statistically speaking, it's too early to tell.
Okay, and Daryl, what's your views on ESG?
Yeah, this is an interesting one. Last year we did a lot of academic reading on this space, looking at papers that have been published over the last probably 10, 15 years on ESG management, sustainable policies within organizations. And I can't remember the exact paper. There's some very good ones from the Harvard Business Review that actually demonstrate firms with what they call sustainable corporate policies actually do outperform in the long term. In other words, they picking up the previous presentation, they eschew the short term for longer term gain. I think marketing probably jumped on the bandwagon in the first part of this year. ESG funds performed really well when the market crashed. Well, you could argue that ESG funds are full of more defensive companies and full of quality, and so potentially there was a flight to them. I think the myth that funds underperform originates probably from some work done in the States, where there were an early series of ESG funds that performed very badly because they were driven by over-exclusion. In summary, I would say ESG and performance depends on what factors you're applying as part of your screen or your positive screen. And this is why I say, from an investment perspective, understanding the impact of any individual factor, it's like macro factor investing or anything else. It can drive performance, it can drive risk, it can drive a number of things. But ESG in total, I don't think there's any proof that it's a bad thing for performance.
Thank you. And Ben, how have you seen performance in the ESG models?
Yeah, I think the thing I'd say first and foremost is going back to the idea of myths. It is first and foremost trying to just make sure we dispel the myth that integrating ESG considerations or taking a sustainable overview of investments is detrimental to performance. I think it is probably relatively clear that there isn't an inherent link to underperformance. Our view is that there is a growing body of data that suggests that integrating ESG characteristics and sustainability in investment portfolios can help improve longer-term returns. There's a few points there to make. Firstly, like any investment viewpoint, but particularly when framing things in the context of sustainability, the timeframes are very important. I don't think anyone should be suggesting that ESG and sustainability metrics will or should provide outperformance over any given time period. These are long structural trends, what we believe anyway, that should support these types of assets. As has already been highlighted, some of the outperformance that's been exhibited year to date will be because of areas that the portfolios haven't had exposure to, that if we see a cyclical value rally, would I expect our responsible investment strategies to underperform over those short windows? So then my answer would probably be yes. But our view is that what you're actually trying to identify with ESG analysis is, as has already been highlighted, strong, effective management teams, adaptable business models, quality in essence. And if we look at the broader sustainability agenda, and I think the structural drivers behind that, both from a macro perspective of greater commonality around policy agendas, changing consumer trends, then we think that there are some significant tailwinds looking further ahead. But the last point I would make, is that everyone talks about ESG, not everyone, but a lot of people talk about ESG in one breath. And I think it's important to know that there's bad ESG strategies and there's good ESG strategies. So let's not we all like to do this, or I do as a fund selector, to neatly house things in totality. But you've still got to do your analysis and understand, as Daryl mentioned, what the drivers are underneath those types of performance.
Okay, now this is a question more for Ben and Ian. To what extent do you feel that your businesses are discussing ESG with clients in a proactive way, or is it more driven by the clients? And I'll start with Ben.
Yeah, so our business model is primarily based about working alongside financial advisors. So we frame a lot of our conversations to clients, but also via the intermediary world. And it's certainly not a one-way street. We have inbound queries from underlying clients, but also from advisors about what are we doing in the space, how are we integrating ESG more broadly, what our specific investment solution is with very explicit ESG and sustainability characteristics are. But also, I think this comes back to the point about the evolving nature of our industry is we've tried to be proactive in engaging with end consumers, but importantly with advisors, to make them aware about what it is that we do at Brooks Macdonald, how we frame ESG and sustainability. And this, again, comes back to conversations that we've had today about just the disparate nature of the market at the moment and different approaches. And absolutely, there's drives towards commonality and common taxonomies and EU directives. But I think we're doing a lot of work to just try and make it clear to the advisors that we work with and to their end clients what it is that we offer at Brooks Macdonald, and be as transparent as possible. Because ultimately, I think certainly, if you're looking at risks and opportunities, risks, we haven't mentioned greenwashing today, and it's a whole other debate. But I think a lot of the concerns around greenwashing is just when people aren't clear enough in what they say, but clear enough in what they do and how they communicate that. Not due to nefarious actors, it's just not good communication.
Okay, and Ian, how about at Barclays? How proactive are you with the ESG discussions?
Yeah, so I think at Barclays, we certainly have been very proactive. Any high net worth individual that comes to us and steps through our risk profiling and questionnaire process is explicitly asked about their ESG preferences, and a discussion can then ensue at that stage. Thinking of our more mass market offering, that's our fund platform, Smart Investor. there's a whole section there dedicated to ESG investments and funds, and really highlighting and showcasing what the industry has to offer.
Thank you. And now a question more specifically for Daryl. Now, a lot of the conversation has been suggesting there's going to be strong growth in ESG. And so I wonder, as a supplier to the wealth management industry, what do you feel you need to do to support the growth in ESG?
I think we gave this careful consideration last year before we launched on the build of our ESG Manager product. And the fundamental in that was flexibility, because we see that the product offering of firms is evolving in the way that they integrate ESG within the management of client portfolios. The understanding of data is growing very rapidly, and what data you actually want to use. The way that clients express preferences may well start as a simple, I just want it greener, through to I want it better socially balanced or better managed or governed, and may then expand down. And what you've got to do from my perspective is put a framework in place that allows this to evolve. And I think we're going to see, as I said earlier, the evolution of ESG factor usage within client portfolios very rapidly. And it is a case that you can have mass customization around it. You can have self-service, as we talked about earlier, and you can have analysis and reporting on this. But what's most important for a firm is to say, well, this is where we start. This is where we expect to go, but make sure that they don't actually box themselves in terms of data or systems capability, and so that they don't have the flexibility going forward. And I think in the next 2 to 3 years, we'll see really quite sophisticated approaches on many of the high and ultra high net worth portfolios, and also a much better way of looking at mutual funds.
Thank you, Daryl. Now, being conscious of the time, I'll make this the last question. It's just asking, do you think ESG will become a regulatory requirement? And if so, when do you think that will take place? So I'll start with Ian.
I think aspects of ESG are already becoming regulatory requirements. I mean, some of the presentations today have touched on this, whether it's EU taxonomy, MiFID II client considerations, or disclosures in prospectuses around the ESG and sustainability characteristics of funds. So I certainly think there is, we've only just started on this regulatory journey, actually.
Okay, how about you, Ben?
Yeah, absolutely agree with Ian there that elements of this already coming into regulation, and the roadmap is pretty chock-a-block with developments if they all do come through. I mean, there's been some sort of uncertainty thrown in terms of timings regarding a lot of this is coming via the EU and MiFID, and when that will be implemented in the UK post-Brexit and with the COVID uncertainty, it is unknown. But I think it's going to happen. And in our opinion, it's better to try and be proactive around these things. Completely agree with what Daryl said, is that this is an evolution, and I think firms need to be aware of that and be adaptable to that. And then finally, I think where you look at a lot of the regulations and where they're leading to, certainly on the investment side, it's around reporting as well. And I think there does need to be some greater consistency and technology around how you report these types of characteristics to end clients if you do espouse to say that you have ESG and sustainability characteristics.
Okay, and Daryl, do you have anything else you'd like to add?
Very quickly, I think climate is already strongly on the regulators' agenda and will probably be the thing that's pushed through and forced through first. They've also talked about labour metrics and labour practices within organisations, so that is hot on its heels. I think it will be harder to regulate around many of the other areas, simply because they are more, qualitative factors rather than necessarily as quantitative, and they're not necessarily things you can legislate for.
Thank you. Well, look, being conscious of time, I will bring a close now to the panel session and the webinar itself. So I'd very much like to thank each of our panelists for giving up their time today and for our speakers. And also thank you once again to our sponsors, Crealogix and BITA Risk, for their support in hosting this webinar. Also, thank you very much for you all for listening and logging in. So please do keep a lookout for our webinars, and we hope you can join us in one of the future ones. And I also should mention that any slides from today will be shared as well as a recording of this webinar. But until the next one, have a lovely evening. Thanks again for listening.